Hello everyone, this is John Rosengard with Environmental Risk Communications. Thanks for joining our webinar today on calculating and managing environmental counterparty risk. To give you a sense of our outline for today, we'll be going through a definition of what is counterparty risk, covering why counterparty risk matters, and then going into a little more detail about who are your environmental counterparties and how to manage and mitigate that risk. Keep in mind we'll be recording this presentation, so we won't be taking questions during this particular webinar. If you do have questions throughout, please feel free to drop me an email. A little bit of background about me. I'm the founder and CEO of a company called Environmental Risk Communications based in Oakland, California. I'm also the author of a software package called Defender, starting in 1994, which just looks at different types of environmental liabilities. And I've got several of them listed here on the slide you're seeing. Our work brings us in support of corporate remediation teams, PRP groups, port authorities on the public sector side, as well as the engineering, consulting, and legal partners and the internal and external auditors working with them. A little bit of background about my work on this topic. I've been a member of the ASTM E2137 work group and E2173 work group that covers environmental cost estimation and environmental liability disclosure. This is all work that we undertook in 2016 to update those two standards. If you'd like to see more information about those standards, I'd recommend going to the astm.org website and get more background information. We really did an extensive rework of both of those standards earlier this year. By way of educational background, my full bio is on my LinkedIn profile. I've got an MBA from Northwestern and a bachelor's in business from Georgetown. So just a couple of highlights about how I'm coming at this topic today. I'm not coming at this as an attorney, as a CPA, as an environmental engineering consultant of any kind. I come at this topic as a person who's worked in this field for 28 years now and worked with a wide range of companies on a wide range of sites about how they forecast their environmental liabilities and try and discharge them as efficiently as possible. I'm a software developer too. So my perspective is again not from coming at it from the law, strictly speaking, the accounting or the science side. Like all of you that work in this field, I'm a multidisciplinary person, but I come at this from a business perspective. With that in mind, let's get into our presentation here today with a definition of what is counterparty risk. Strictly speaking, the accounting terminology is very, very clear. Counterparty risk is called the non-performance risk of default, which means that you've got someone who you're trusting to carry out some work more or less on your behalf, or at least as a task that you might be required to do at some point. If they don't perform, that in turn is your counterparty risk because you'll have to step into their shoes and do that work for them. Financially speaking, it's the incremental expense of that other party's unfulfilled obligation to you, which in turn drives how you calculate the value of your own environmental liability. So in other words, you can have the environmental liability itself valued at zero. But if the reason that it's zero, one of the principal reasons that it's zero, is someone else is intending to do the work that you might otherwise be required to do, well, now everything depends on the financial health and the ability to perform of that counterparty. And so that counterparty is, again, someone that affects the value at which you book or transfer a liability. In an obligation, usually this type of activity is self-insured. There isn't a third-party marketplace, generally speaking, to proportionally assume a defaulter's liabilities. So self-insurance is the normal mechanism for observing, calculating, and protecting yourself from that counterparty risk. Let me give you a couple of examples of what counterparty risk looks like. Let's say your company sells a plant to its operating management in 2007, and you've got, in turn, a $2 million asset retirement obligation, or ARO, and a $4 million RCRA closure, and both of those environmental liabilities go to the operating plant manager, so they get the assets as well as these two environmental liabilities, as well as a variety of other components related to the transaction. Their credit rating today, 10 years after the asset purchase and sale agreement concluded, is now indicating that they've got a 65% probability of bankruptcy in the next 18 months. This type of information is based on credit scores, and credit scores can be modeled going forward. These are advances that ERCI has been working on for 15 years, and we're not alone. Extrapolating short-term credit scores into long-term credit trends is something that's we found to be incredibly useful in looking at not just 2-party sites, but 3, 5, 50-party sites in order to gauge, calculate, and quantify the environmental counterparty risk. So how you would look at that for the specific situation here, and under the Book Now column, you would normally allocate a 65% chance of that $2 million liability coming back to you, as well as a 65% chance of the $4 million liability coming back to you, for a grand total right now of $3.9 million before you do any adjustments for inflation, which may have changed in the time span from 2007 to present, if those estimates are really from back then, and any new regulations that have come into play since the time of the transaction, or since, more accurately, the time of that calculation. What next steps to be ready for? Well, 65% probability of bankruptcy is significant enough that you might not have 6 to 18 months of time to work with. Therefore, you may just have to be ready to assert a claim in bankruptcy and say, if we hear about a filing, directly or indirectly, we will probably have a very short amount of time, 1 to 6 months is fairly common, to assert a claim and let a bankruptcy judge, perhaps even an environmental regulator, come in and identify whether your company's got a long-term liability. This is a legal issue. So this is a cost times probability legal issue to get involved with internal and external counsel to make sure that you have good advice and good quantification of risks, numbers, and so on relevant to your jurisdiction. So if I'm giving any legal advice today, it's to consult an attorney when you're looking at the prospects, the possibility of a bankruptcy claim. But strictly speaking, the math, as far as it goes, is if you can take a credit rating that's, generally speaking, commercially available or in the public domain, you can take a credit score and convert that into a probability of default. That has never been easier. The worst case scenario for this type of liability is that you not only come in and decide that it's more wise of you to perform the work in the short term, but you also find out about other releases that are potentially stranded liabilities and make a decision about whether to do study and remediation work on those as well. It's happened before. Next example in the following row is your outside laboratory fails a regulatory audit, a not unheard of outcome. The data from the last 2 years is reclassified by regulators just universally as uncertified, which means you're working with unvalidated or unconfirmed data on your particular environmental remediation or environmental liabilities. What you do need to book now is the cost to redo the samples over the coming years. One thing that you've got available to you is making a claim to the lab and to their corresponding, perhaps, insurance carrier to have them make good on their false data or invalidated data and replace that with better data. Another activity is to just reevaluate where your exposures are. If you did not use the lab very much or just use it on a limited number of sites, great. The cost to mitigate may be too small to file a claim for. However, if it's data that made you revisit how you carried out cleanups, made you revisit the value of monitoring a site and so on, you're in the worst case scenario perhaps of correcting a material financial error where you went one way or the other. You stopped a cleanup that needed to go on, or vice versa. The third example that I'd like to share with you is your plant kept insurance in place, commercial general liability insurance from 1950 to 1980. Many years after that insurance went out of effect, offsite sediment contamination was found in 2009. That insurance carrier traced the liability back to when their coverage was in place, in whole or in part, and in turn the carrier is paying claims at the rate of 50% until 2017, and then in 2017 it needs, unfortunately, to do what many insurance carriers do, which is to dissolve. So there, you're looking at now saying the cleanup work that was scheduled for the future is now going to go from being 50-50 covered by someone else to now being 100-0 covered by just us. So your next steps really are to book the remaining liability that used to be covered by others, file a final claim, and see if any future claim costs can be satisfied. And your worst case scenario, of course, is that they cannot. The final example that I wanted to share with you, again, these are just ERCI's examples. These aren't from GAAP citations, generally accepted accounting principles. These are just case studies that we think communicate the need for calculating counterparty risk. So our last example here is your company agrees to jointly fund a surplus settlement study, not an unusual outcome at all. 2 years ago, your allocation on this study and cleanup work, however, was only 8%. Now at the moment, it's 10% and seems to be growing due to the defaults of some members of the PRP group. At any rate, counterparty risk indicates that your share is going to continue to grow. We can actually demonstrate a growing predictable rate. We'll cover that a little bit later here in our webinar today. One thing that you can do if you're not doing it already is to do what GAAP tells you to do, which is monitor the health of your counterparties and then take the proactive steps of cashing them out before they leave the stage. The worst case is that the counterparties beat you to the punch. They liquidate before you get a chance to act. So why does this risk all matter? Well, under federal law, joint and several liability basically applies to environmental liabilities. In other words, if you're sharing a liability with another party, and I'll get into that in a little bit, you're in a position of being, and you're in a position of being a larger or healthier PRP, you're doing something called providing counterparty risk insurance. And by default, that transfers their costs to other PRPs like you and not on to the government for an orphan share. That's the typical normal outcome or application of this aspect of federal law, as I understand it today. U.S. federal law specifically was the Superfund law from 1980. It created, again, something called joint and several liability. If you get some of your background from just Googling a term, I recommend using that term in that order with those three words, joint and several, and how it applies to environmental liabilities, if you want more information and background. However, specifically as it applies to how to book and calculate an environmental liability, general accepted accounting principles make this aspect of understanding, knowing counterparty risk, make this mandatory. And I don't mean that this is a relatively new aspect of calculations. This has been a requirement for, in some cases, 2 years, in some cases, 20 years or more. Another trend that we observe that makes this risk relevant to our work is that we see counterparty risk is accelerating as we have fewer larger companies and the worldwide economy becomes more integrated. I know those are very vague, generalized terms, but as we have a more interconnected, globalized economy, counterparty risk is accelerating from what it was before. We've observed this in our work over the last 15 years. So who are your counterparties? These are this is ERCI's list. This doesn't come from any place else, but this is our list of what we've seen in doing our work here. First of all, the number one counterparty that's out there is an indemnitor, someone who made a contractual promise to you, or someone who, by federal law, is already joined with you in your business. So who are they? They're, generally speaking, these four types: successor, owners, and tenants. Someone who buys a property from you or from one of your predecessors, and so on and so on and so on. The next type are predecessors themselves, who owned a property or an asset before you, or agreed to share in the cost of a liability. And they can include not just property owners, but also tenants. So if you've been a landlord, or if you've been a tenant, it applies, as well as whether you've been, strictly speaking, a current, present, or former owner of, or you are a future owner of a property. Joint venture partners. If you're sharing in a multi-party investment, by default, you share equally according to your ownership in that multi-party liability, unless you decide otherwise. So if you, for example, drill an oil or gas well, and you have a 25% ownership share with 3 other parties, you also have a 25% ownership share of any problems that come up. But again, that's based on the agreements that you sign, the contracts that you have in place, which and then might have to be enforced by not only yourselves or each other as working partners, but also by state, federal regulators, or any interested or impacted parties that are nearby and share the environment with you. The fourth type that we see out there: banks or insurers or sureties that are providing financial assurance or guarantees to any of the above parties. So if any of the above parties are a company or a government or a partnership or an individual, great. But sometimes in cases you're working with the insurer who backs them up, that insurer is your counterparty as well. Other types of counterparties are, of course, the classic one that you see on Superfund cleanups where costs are shared with many parties, and those are your fellow potentially responsible parties or PRPs. Because you each have been either told by a government or you've agreed with each other or with the government that you're going to share in some aspect of cash calls to fund study and or remediation and or operations and maintenance work. Therefore, because you've agreed to share costs, again, it starts with a contract normally, but there's also a federal law that under joint and several liability brings you together as co-users, co-polluters, if you will, for a given asset or a given cleanup site. Other types of counterparties are adjacent property owners who share a common pathway. And I know this might seem like a little bit of a stretch, but if you share a storm sewer or a wetland, a receptor, your storm water goes with somebody else's storm water. They have a fire, you don't have a fire, but you all send some materials coming from your site down to this receptor or this riverbed or what have you. Your adjacent property owners can become your counterparties very, very quickly by virtue of sharing a downstream receptor that at some point might get studied, might get remediated, and might be drawing everyone into to making claims against each other. It's happening right now on major waterways, particularly in the East Coast and Gulf Coast, and then the Pacific Northwest. If you need some research on those, drop me an email. I'll give you some examples of sites like these. But basically the idea that your adjacent property owners that you have nothing to do with can affect your environmental liabilities is because you're counterparties to each other. If one gets healthier, one gets weaker to the point where one can do the work and one can't, then you have definitely a counterparty risk situation. The final example that I'd like to share with you today, not an exhaustive list, but I think a pretty comprehensive one from our operating experience at ERCI, is landfills or transportation storage and disposal facilities. In other words, these are people that collect industrial and municipal waste and store it or agree to treat it. Those are the facilities that you have to have trust in that they're going to take care of the problem and the problem will not come back to you. Why? The number one or number two source of Superfund sites over the last 35 years now has been landfills on the municipal or privately owned level that have not been able to complete their environmental life cycle closure costs, and therefore those life cycle costs of managing the landfill went back to the people that sent the waste to the landfill. And that can be anywhere from hundreds to thousands of individual counterparties. But anyway, that's our definition at ERCI of who are counterparties. When you talk with people that work at a Fortune 500 company about who counterparties are, they could say, well, our banks, well, our trading partners, well, our key customers. And that's completely understandable. That is the classic definition of counterparties because those are the day in, day out people that affect the balance statement, the balance sheet, the income statement, the cash flow statement of a company. However, working in the environmental liability field, we've got a different subset that law experience in the School of Hard Knocks teaches us that we're working with. These are people on this list here that we find ourselves working with, not by choice, but just by circumstances that were set in motion long ago. So which types of counterparties are problematic? ERCI's work brings us into tracking the health of counterparties and recommending some mitigative action. The short answer is everybody's a problem in some way or another. So we identify a couple behaviors that we encourage everyone to watch for. If they're in different layers of corporations, we watch for disclosures of creditworthiness because we do have to track that down. Second, if an organization won't sign a PRP agreement, that's probably a sign that they're going to be a riskier counterparty than others. If they won't be able to or refuse, for whatever reason, execute a parental guarantee or a letter of credit. Observing corporate formalities, totally normal. However, in environmental liabilities, there are successors and assigns rules in place for bankruptcies, for dissolution of subsidiaries, and so on. The simple point is if a company knows it has an environmental liability somewhere in its family tree, it has a variety of tools at its disposal, and one of those that you can work through to cancel out the impact of a complicated family history, family tree, is getting a parental guarantee or a letter of credit. If there's a refusal to get that, then of course you've got a counterparty who's being problematic. Other behaviors to watch out for: high employee turnover, high inside or outside counsel turnover. In other words, very low institutional memory, lots of compartmentalization. In other words, a counterparty that's good at forgetting. That's my watchword. Watchword phrase. If a counterparty is good at forgetting, we'll probably have to take some extraordinary steps to mitigate that. If a counterparty acts like a claims adjuster, that it's all about the checks and about the money, not about contributing expertise or experience or vendor knowledge or a network of professional contacts in a geographic area of a site, if they're just at this at an environmental liability from the perspective of what will it cost, not what can I do to resolve the situation most efficiently. Again, keep in mind you have passive partners and you have active partners like any partnership. Environmental liabilities are much the same way. You have some low share, low allocation, low liability partners who will probably not want to take turns driving the liability. Other behaviors that you want to look for, of course, as I just mentioned, no in-kind work contribution, but also being slow to pay, having checks from all over the economy. And this site, this environmental liability, is their only environmental liability. These are problem behaviors that those that have dozens or hundreds of environmental liabilities will see as common traits. If someone is learning on a single site, they tend to behave a lot differently than if they've got 20 others just like it to work through. So what level of detail works best? We find that ignoring environmental counterparty risk, not really a great strategy because it's knowable, it's visible, it's actually hiding in plain sight. So I wanted to share with you just these different ideas of you can pick whatever resolution you want to from an aerial photograph. It's completely up to you. It's an unforced error if you decide not to look at what's hiding in plain sight. So a couple of conclusions that ERCI has observed in recognizing trends in counterparty risk over the last 15 years of doing our work, particularly in the last 10, is before and after the most recent major recession. First of all, we see lower average scores. Part of that is large companies getting larger and consolidating. Being above average, well above or well below average in credit standing is a tougher and tougher activity to achieve. But generally speaking, we see lower credit scores just as a general trend because most Fortune 500 companies tend to have above average credit and they tend to survive decades and decades. That's part of it, but we're also watching again a subset of the universe that's an industrial manufacturer or a major waste generator or involved in very specific industries that are critical to the economy. So we're seeing durable, large enterprises that, generally speaking, in the last 10 years, have seen their credit scores go down. Another key part of that is absorbing lots and lots of leverage or taking on lots and lots of debt to continue the business plans of the enterprise. So again, the company that was there 10 years ago with very little debt may have a lot more debt in place because interest rates have been so low for so long. The next trend that we see are unstable scores. We used to see a Fortune 500 company have the same score year after year after year after year and have financials that back that up, that there weren't a lot of volatility points within the financial statements of a balance sheet, an income statement, or a cash flow statement. The statements were stable, therefore the credit score was stable, and now we have the unstable score phenomenon as well as the next two. When scores do move, they're moving across a wider range. They're not moving a point or two, they're moving a dozen points at a time. And that type of erratic motion where a company can be in the 75th percentile one quarter and then 6 months later they're in the 25th percentile. They're on the other side of the mean, the average, and that they're moving more frequently than ever before. These trends are pretty unsettling because, again, it can be axiomatic to think of an environmental liability as being low cost, fundable, and so on. However, our takeaway is that we expect to see more issues with enterprises being able to fund all of their liabilities on a perpetual basis. So we see there's value in doing continuous monitoring. It's very low cost now compared to what it was like 20 years ago. And we also see a shorter action cycle. The time to bankruptcy is actually shortening up quite a bit from from years, in some cases down to months. So how dynamic are credit scores? Back in 2014, a couple of years ago, I pulled the credit scores of all of the companies that you see here and just graphed them on a scale of 0 to 100. The metric that I graphed is the Dun & Bradstreet Financial Stress Score, to be very, very, very specific, which is a commercially available metric. And what I did 2 years later was I graphed the same company just to see where they are on the bell-shaped curve. And that's again part of what Dun & Bradstreet generates, is they're distributing everyone across a bell-shaped curve. What I wanted to communicate to you today is just over the space of 2 years, just how much motion was in place. And you may think of every company that's here is a household name, is very readily recognizable, probably a very, very healthy enterprise, growing enterprise, and so on. However, I want to point out to you that not all of them are equal. Some of them are going through, or have gone through, tough times in the following 2 years. Some went through great recoveries, and I can't think of any other examples than that, other than each one of them survived, but not each one of them survived with their percentile of financial stress score in the exact same place. Most everyone experienced some level of dynamic motion in just that 2-year period. One of the things that I'd like to share with you today, and let me try and do a little bit of high-tech screen switching here on our side, is to show you what our counterparty risk model looks like. We model 3 key dimensions, which are the 3 aspects of the financial statements, the balance sheet, the income statement, and the cash flow statement. We model them each in 3 dimensions, and then we put in a floor, which is this red sort of a tray here, identifying the points of no return. When we see counterparties that drop below this screen, we pretty much know that they're headed for a 1-year, 3-year, 5-year trip to insolvency, dissolution, bankruptcy, and so on. But what it looks like, and I appreciate that this may not record well or store well, but basically that motion is in place, and periodically you'll see a counterparty hit that red shelf and just drop down to the origin, while other parties are just staying in the background, staying with their current operations with above average and healthy income, cash flow, and net worth. That's part of our work and how we apply this information, but I want to give you a different case study of counterparty risk and how it functions to go with that, because having just 5 parties, as I just showed there, is unusual. Often you have just 2 or you have 20. It's very rare that you just have 5 that you can visually track in my example there. Let's take an example here where we've got 15 PRPs. We all have an equal share of multi-party site cleanup. And that cleanup is expected to cost $75 million, and we're not going to be collecting any cash calls for about 10 years. So we have 10 years for counterparty risk to set in and express itself. Let me go over the table about how we calculate counterparty risk. First of all, we identify each party and rank them by their credit score, which is that's the easy part, is figuring out the current credit score. That in turn means there's a 1-year probability of failure going forward to the next year. And there in turn is, if you're able to do Monte Carlo modeling, you can sort of branch that information out through something called the transition matrix and figure out what the 10-year probability of default is. I appreciate I may have just spun off the planet in terms of technical detail, but it's the basics that we're trying to convey here. You have each individual party with their each individual discrete and knowable credit score, and that in turn gives you a short-term probability of default. You can then extrapolate that short-term probability of default into a long-term probability of default, apply that to your large cash call 10 years out, and then figure out what you really are here for, which is to figure out if you're party A or you're party O at the bottom of the list, you know what your cash call is, but what's the offset for the probability of your own default, in other words, that you might not be around to pay. It's always something. And then what the premium is to offset that discount of what share that you'll accumulate from others who default before you do. So again, it's sort of a game of musical chairs, but the stakes are quite a bit different than a game of musical chairs. So again, moving left to right, the initial cash call allocation for everyone is the same. However, over time, there's an offset. And so if we're a healthy company, we expect to pay our $5 million cash call. We deducted $50K by $50K for the offset that we're not going to make it. There's a very, very tiny chance, but still a calculable chance that we will not make it to that 10-year mark to make that large cash call. And then we've got a premium to add on to say what will be the amount of cash calls that we'll pay on behalf of others who don't make it to the 10-year mark. And that we have at $7.5 million. So the grand total of the liability is the net sum of all three. $5 million cash call, less $50K, plus $7.5 million gives us the $12.45 million number that you see displayed in the far right edge of our table here. That's the healthy company. Now if we're correspondingly weak, and there's a very, very high probability of us not making it to the 10-year mark, we again have the same initial cash call. We've got an offset of around $4 million for us not making it. Why is it not 95.4% of $5 million? Well, it's a graduated number. You can go have experienced financial stress at any point in the next several years, and the present value of that is not always zero. It transitions from being a 26%, 27% chance in year one to a much higher probability. So again, that's why it's not 95% times 5 million. It's an integrated number across a time span, to be very specific. Moving off to the right, the premium for our loss, in other words, what we have to mark the liability up for, is what happens in that probability where we survive and other parties don't. So that increases our liability. So again, it's the same three things. We've got our base cash call, the discount for us not making it, the premium for us surviving and having to pick up the share of others. And that gives us our net number. And you can see in both cases, because you're at the tail ends, the successful tail end and the failing tail end, you're not at 5 million. If you're at the middle of the group, the middle of the pack, you can expect that all these risks to cancel each other out, and so your liability is around 5 million. Tough part, no one's guaranteed to be there in 2 years or 5 years, so you do have to think ahead about whether your environmental liability will stay there. So what did all that mean? Number one, if you've got a perfect credit rating, if you have deep pockets, as it's called in the legal field, counterparty risk, generally speaking, can double your cash calls. In the case that we just looked at, it more than doubled the cash calls. If you have average credit rating, premiums and discounts will cancel each other out. Not really a major factor. But you don't know that you're going to be average for the next 2 years, let alone the next 10 years. So having an updated score is incredibly useful. If you have a rock bottom rating, guess what? Your net liability is actually half the cash calls because the healthier counterparties are more likely than not going to have to cover you. And that goes into the value of your calculations. And there's actually a nickname for that. It's called the deadbeat dividend. I didn't make it up. It was just in the literature during the last recession where companies that you didn't expect to be profitable were suddenly showing break-even or profitability during a very, very bad quarter. And part of that was they were unwinding liabilities that they probably had no chance of ever paying off in the foreseeable future. And as some circumstances unfortunately played out, they didn't have a chance of paying off certain liabilities. Consequently, the process of unwinding liabilities shows up on an income statement as though it's products sold at a profit. So again, it takes some expertise to look at an income statement or balance sheet and discern that that's what's going on. But basically, deadbeat dividend is part of this process too, in that a healthier company doesn't get a deadbeat dividend, but a company that's weakening over time and unwinds the probability that it won't be able to pay, forwards that deadbeat dividend down to their books. What else can you take away from that? Healthy PRPs are probably giving away joint and several insurance. That's my term of joint and several insurance, but they're probably, that verification that the work is going to get done and any stranded shares are going to get paid, I term that to be insurance. However, no one is telling anybody to give that insurance away to other counterparties and to regulators, and probably without any authorization. So I just want to daylight this as a business concern. It's one thing to say, I work for a healthy company, we take care of our environmental liabilities. It's one thing to say that. It's great to say that, but it's another thing altogether to step back and say, and we're going to pay the liabilities of those that don't plan for the long term and don't intend to fully fund their life cycle liabilities that are going to be incurred 10, 50, 100 years out. So at any rate, I do want to point out that there's a transaction going on here, whether you recognize it or not. It's probably growing to be material, whether you recognize it or not. Probably your number one source of new sites and reopeners of closed sites is counterparty failure. So again, I just want to keep up the idea that if there's a transaction going on, it should be a free one. So a little bit about the GAAP citations. General accepted accounting principles is the term for GAAP. The reason that I'm putting these up is to not give you too much of an education, but to point your colleagues who may be more closely working with accounting citations to just show you what language is in place here in the U.S. for looking at this aspect of environmental liabilities. This language has actually been around since 1996. It was originally in a document called SOP 96-1. This language verbatim was just translated in 2009 into a document called ASC 410-30. So the exact citation, the exact paragraph is given here on the screen here. But I do just want to point out, if you run a corporation in the U.S., you work for a company in the U.S. or a nonprofit, FASB, the Financial Accounting Standards Board in Connecticut, they are one of your major standard setters. And this is their language, and it's drawn originally from a document back in 1996. So it's not new. You can Google this terminology and find it primarily from ASC 410, but also from several other sources going back several decades now. The number one item that I just want to point out to you is just this very first one. Assess the likelihood that other potentially responsible parties will pay their full allocable share of the joint and several liability. There's no limitations here for just federal cleanup sites, just Superfund sites. These are all lowercase numbers, conveying the idea that there's not a strict definition that just applies to U.S. EPA-controlled cleanup sites just here in the U.S. This has got global applicability for companies that comply with U.S. General Accepted Accounting Principles. The more detailed language you see is a few paragraphs later in the very same document. An entity should assess the likelihood that each party will pay its share, and that'll be based on the financial condition, and updating and monitoring that information is relevant. But anyway, that's what brings us here today, is this part, but it's also repeated in some other parts under the fair value measurement subtopic, which is called ASC 820 here for U.S. corporations. The fair value of a liability reflects the effect of non-performance risk. In other words, that premium that we'll have to pick up other people's shares and the discount that we won't be able to pay our own share gets factored in. That's where this idea comes from. If you work for a public agency like a state or county or municipal government or a port authority, your financial accounting standard setter is called GASB, the Government Accounting Standards Board. In Statement 72, paragraph 62, you see pretty much the same language. It's not an accident. FASB and GASB are in the same office building in Connecticut. They share some of the same staff, a lot of the same projects, a lot of the same expertise and experts. So it's by no accident that the federally funded, the SEC-funded setters of financial standards here in the U.S. for corporations and public agencies see eye to eye on lots of aspects of how to track counterparty risk. It is no coincidence at all. With that in mind, I just want to talk to you a little bit about the math that ERCI does in calculating this risk, because what we're really doing at the heart of our activities, we're taking short-term credit metrics, which is all that is out there and published and for sale, is the short-term assessments of where will someone be based on their financial statements of the last several quarters, where are they going to be in the next few quarters. What we do at ERCI is we apply probabilistic ranges to each of those organizations to give these long-term trends. And it's, again, based on experience. So this is a simplified visualization where each organization goes. And you see that uncertainty sets in really fast. This isn't a prediction about any individual company, but it's just the idea that you can have a great position in terms of where you are in the economy, and you may work on the precept that the rich get richer, rich companies get richer, but there is no guarantee that an organization will still be around in 1 year, let alone 30 years. So what we do to calculate counterparty risk is we go through a site-specific process to aggregate that information to a portfolio. We start off with allocations as they're known today, the cash flows on a site, so we can schedule the risk and the corresponding premiums and discounts accordingly. And then we apply I think the most important part, which is called the transition matrix. What are the chances that an organization that was healthy one year will file for bankruptcy next year or default on their environmental liability 1, 2, 3, 4, 5 years, and so on. That in turn leads to some complicated math because you have sort of a residual accumulating state of you start with 100% and then you have a gradually diminishing group over time. And you don't have parties sort of spring back from default. Once they default, then they're done. So you have this what's called an absorbing state Markov chain Monte Carlo model that we do. That's part of the transition matrix. And we again think that sort of calculation, which we do at a very, very simple level in a forecasting engine inside of Excel, and we display a crystal ball output, a range that people are used to seeing. We think the math is very straightforward, but the logic behind it, and then in turn the cash flow calculations, is there are places to get the numbers oversimplified and to miss out on the accuracy of them. But what we've again learned is that these counterparty risks are in place and they're growing. So what are the dynamics that are in place? Start with number one. There's an average 1.4% a year default rate plus a 6% a year dissolution rate, which means the corporation is just scratched out and maybe replaced with something else, maybe replaced with a successor or a son. I won't bleed over into the legal issues of so on and so on. But the point that I want to get to in the calculation here is that you have to expect that 1.4% default rate is an absorbing state and an accumulating value, and that it only gets worse over time. But when you randomize for credit ratings, you don't know if everyone in your group has equally healthy 1.4% a year probability default. You have to randomize for that in your range of possible outcomes. And then you have to randomize for the allocations that each party has. In other words, you might be a 2% party and not really be all that worried about whether healthy or unhealthy parties survive. But if the largest party is 90% of the allocation and has an incredibly weak credit score, guess what? You can be facing this liability in very, very short order. So randomizing in all these dimensions gets to be a little more problematic to just talk through. It's easier to display it and to show the living, breathing, iterative nature of it. But the point that I want to share with you today is that in one project, any one project, you can lose all of your counterparties next year, and you will know exactly the same then that you know today. You can identify today how healthy or how weak everyone is right now. With that, let me move forward to how to manage counterparty risk. The number one step that you can take, of course, is know the situations and know who your counterparties are. The number one trait that I listen for is how a counterparty describes themselves. If they describe themselves as being here in place of a defunct subsidiary that is backed up by an insurance company that's no longer has any employees or no longer has any income and has very few assets, I listen for those curious descriptions to try and get a sense of just how viable an entity is. You can have a representative come from the largest company in the country and say, I'm here on behalf of this defunct subsidiary, and we're not planning on doing a lot because we think of this environmental liability as a claim and not as a project whose outcome we have a lot of stake in. So again, keep that in mind. There may be some public domain data to work with, like company history or 10K reports, where an individual site gets called out. So if you're, again, building information about your counterparties, do what we all do here in the U.S., build a database around it, and don't rely on anything other than your own smarts about storing what you learn as you go forward. Finally, don't rely on consistency. Your counterparties will probably change representatives over time. So you'll have lots of institutional loss accumulating over the years and decades that an environmental liability can take to resolve. The steps you can take to act: number one, doing an ability to pay analysis. We do that all the time. EPA has a fairly good tool out there. It requires 3 years of tax returns that you might not always get your hands on, but you have the ability to get public domain information like financial statements, like credit scores and so on, from a variety of commercial sources some of which we're tapped into. And again, we find it's useful to do that ability to pay analysis first. Find out what the corporate relationships, the corporate family tree looks like. Next, focus on where the risk is. Companies that are in, companies or public agencies that are in the bottom 10% of the economy are where most of your financial stress is going to come from. And they're hiding in plain sight. They have low credit scores, they have low commercial paper ratings, they have low bond ratings. There is no secret that they're in financial stress because we're a chatty, talkative group of people. We understand that knowing this and helping that enterprise work their way through is just good business for everybody. So again, keep in mind that you can Google things you couldn't Google 10 or 20 years ago. You can also find out who's in the bottom 10% pretty readily. The next steps are the tough steps. These are the difficult conversations. I've participated in many of them now. But getting the parental guarantees, getting the letter of credit, getting the corporate formalities straightened out and documented is an important step. Sometimes it's as simple as getting an assumption or guarantee or some sort of collateralization done or indemnification executed from a defunct subsidiary to a parental company who's still in operation, and then from that parental company on over to a multi-party group. I've seen it done, I've done it, and I just got to say it takes a little bit of time. It's not something you can do in an hour, but it does take the input of a couple people. And getting a guarantee, which is generally speaking no cost, getting a letter of credit, which generally speaking does have a cost, are steps that do take a few weeks. They do not take months and years. If it does seem to take months and years, there are probably some hidden reasons for that. It's not the process itself. Next step that we see as being particularly valuable is redocumenting the status of everyone every year. Maybe every year is overkill, but certainly every 3 years provides enough time for an entity to say, aha, we need to dissolve that subsidiary. After 3 years, there's probably a very roughly speaking, a 20% chance that an enterprise is either considering dissolution or considering bankruptcy. So I'd say anywhere from every year to every 2 or 3 years is a reasonable level of effort. Every 5 years is not a reasonable level of effort in our economy today. It's just too long, and counterparty risk feeds on time. It needs time to survive. It needs time to grow. If you starve it of time, you're going to reduce counterparty risk. Last thing you could do, keep a scorecard. Share the stories and cautionary tales about how you eliminated, prevented, and reduced counterparty risk. And remember, you're applying something called the intelligence cycle, which you can look up in Google if you want more information. You're implementing a process. This is not a project all by itself. This is a process that you'll need to have, more or less, for as long as you have environmental liabilities, which based on your industry might be forever. But what you're doing, again, is you're developing information, you're collecting that information, you're trying to process and exploit it, and then disseminate to people that need it. And again, you're trying to do that faster and faster for less and less cost over time. You have to get good at that. And you have to realize that your counterparties are probably just part of who you're going to be in business with over the long term. You're always going to be in the business of buying and selling assets, which means you're always going to be in the business of being curious, if not actively motivated, to understand a counterparty's health rather. Other ways that we've implemented this are in a peer-to-peer financial assurance process for a PRP group who's watching 5 to 50 different PRPs within the group. We've got several of these going on right now for large Superfund site project teams, PRP teams, and we found that this primary, secondary, tertiary testing model works pretty well. Everyone gets measured the same way, the same time every year. We're now able to look at credit reports on telephones. We used to have to request faxes by phone calls, so there's been lots of great progress in the technology. However, there's still a need to act. We still need to put some organizations into workout, have the uncomfortable conversation to say, your organization fell below the financial standards that we all agreed to, therefore we have to have either a letter of credit or we have to work out a cash out agreement with you. Having those conversations and enforcing these PRP agreements is again something we've been involved in and we find particularly value into, because you want to keep most of the organizations out of the testing. and that's the purpose of the primary testing, is to kick the healthy companies out of your testing process and not try to learn anything that isn't going to be worth anything when you learn it. Learning that the most profitable company in the U.S. is still one of the 5 most profitable companies in the U.S., that's not useful information to collect and document and try and use. That's information that you throw away for this process. What you do want to find out is if someone has slipped from the 21st percentile down to the 9th percentile, because now the probability of their defaulting in the next 18 months just zoomed up dramatically. That's the kind of information you want to find, and that's not pleasant front page of the newspaper information, but generally speaking, it is available, and you want to be able to act on that because, again, it's why you're there. You're trying to prevent loss of allocation on these higher cost multi-party site cleanups. In the case of some cleanups, let me give you a couple of examples. If you're looking at sediment cleanups in New Jersey, the Gulf Coast of the U.S., the Pacific Northwest, there are probably a half dozen case studies going on right now. The range of costs, $300 million to $2 billion, spread among 10 to 200 different parties, and maybe even more. Each party is probably then in turn very interested in whether there's going to be a $10 or $100 million stranded share of a liability because a counterparty decided that they had all they could take and they're going out of business. Knowing that a cleanup can take 30 years, which is plenty of time for counterparty risk to set in, that there may be an afternoon where it's wise to say, okay, last year you were at the 21st percentile, now you're at the 9th. Before we read in the newspaper that you're filing bankruptcy and dissolving this enterprise and walking away from your cleanup liability, let's have a talk about how to do something more orderly. So the business case for counterparty tracking, pretty straightforward. You're trying to speed up payments for riskier parties. This is what your core business does already for its troublesome customers. It tries to speed up payments for the riskier parties and not spend a lot of time fretting over whether their healthier customers are eventually going to complete their paperwork and pay their invoices. However, what you're trying to do is identify the need for a healthy PRP, to say that it's got long-term credit risk from everybody. Again, focus your attention on very specific long-term credit risks from very specific parties. When a counterparty does file bankruptcy, you're actually way too late. You're actually 6 months to 2 years behind where you could have been. But if you have a financial assurance instrument in place, then you've avoided the trip into bankruptcy court and filing a claim because you have a preferential instrument. You have a financial instrument that's not simply an IOU that you're trying to now convert into cash. You have a letter of credit that you can very, very readily convert into cash and short circuit or avoid the process of going into a bankruptcy claim situation. This is also GAAP compliant because you're complying with ASC 410-30-25-12, which means you're dealing with the uncertainties related to the allocation of a cost estimate. So what do you know about your counterparties today? Generally speaking, you know about the identities, you know about any terms of contracts like leases and purchase and sale agreements. You have copies of those. You can find that. You can also find out pretty readily different types of current credit ratings and capacities. Several sources. I can identify at the top of my head at least 5 sources that you can go to today to get commercial credit score information on any entity that's active worldwide. Finally, if a company is publicly traded, you can take a look at their financials, looking back decades now on public domain information that's published by different financial regulators. And you can possibly, through those documents, get some insights about disclosures about their reserve policy for even individual sites. That's what you can learn. What can't you learn? If they've transferred an environmental liability onward to somebody else, if they've completed internal paperwork that says, okay, we are entity X, now entity Y is responsible for that cleanup liability. Wish everyone who tries to find you the very best of luck of finding this document and finding you, entity Y. Okay, you don't know that. You have to ask and find that out. If there's a reasonable reserve for a counterparty liability, if they've bought insurance coverage and are covered by an insurer, you have to ask that. You have to probe a little bit, not in acute detail, but you do have to ask a simple question about how are cash calls going to get paid over the next 30 years, particularly if your enterprise might go away in that 30-year time span. So let's wrap up on a couple of topics here. Number one, why do your counterparties matter? Well, it's the number one source of your new environmental liabilities coming in the door today. If you need some verification of that, please drop me an email. I'll be glad to give you a couple of case studies or look at your situation and talk it through quickly. Second, this is the number one cause of your growing allocations on your existing multi-party sites. So it's a major cost driver for both brand new sites coming in the door and costs on existing sites going up through the roof. Next, there are clear benefits from thoughtful, preemptive action. I've implemented those actions firsthand, so I'm telling you from firsthand experience, you can do wise things with your company's scarce capital and avoid counterparty risk. Examples of those, buying back a property before it goes to an environmental regulator for a stranded liability or an orphan site action. You can join a PRP group before a landfill goes into the CERCLA program. You can keep it in a non-CERCLA, non-Superfund cleanup and have a lot more latitude about how you carry things out at a lot lower unit cost. And also you can cash out a PRP before they go into Chapter 7 liquidation, which is what it's called here in the U.S., or Chapter 11 reorganization. Chapter 7 means you've got one final chance, just like Chapter 11 does. But again, keep in mind that there are different types of bankruptcy reorganization here in the U.S. It's actually a totally different type for different municipal, county, and city and public agency bankruptcies. States here in the U.S. and the United States in general do not have the option for going bankrupt. So that's a different type of counterparty risk situation altogether from anything we've covered here today. But again, below the state level, where you've got county, municipal, public agencies, water districts, school districts, and so on, they do have paths into liquidation and reorganization. Next, tracking is mandatory according to GAAP. In materiality, the cost of tracking comes into play. Keep that in mind. You can't just track everyone because it seems like a way to stay busy and pass the hours. Tracking is, however, mandatory. You can't step back and say, well, it's too expensive to Google that XYZ Corp, which had 90% of the liability on our biggest site. It was too expensive to go Google it and see that they were having financial stress and they were planning on closing facilities and laying off employees. Your stakeholders need to know if environmental liabilities are going to boomerang back to them or if allocations are going to continue to grow. But I assert to you, just from trial and error experience, anecdotal evidence, and then overall what we're seeing with larger and larger groups that are more representative of the economy, environmental counterparty risk is significant and is growing. So let me conclude with a couple of ideas about how to report the risks. The number one activity that you want to get started with is figuring out on a single site who the counterparties are, how stable the allocations are, when risks start and end. And then you want to present preventive options like the results of counterparty modeling, the status of guarantees, and the status of any credit enhancements like letters of credit. Periodically remeasure that data and then export it to a portfolio. When you have a portfolio of many, many, many sites, you can group it and subdivide it. You can probably do this as fast as we're talking about it here today. But grouping them by liability type and by counterparty puts you in the position of identifying one very, very special bit of information, which is to understand if any one party represents more than 5% of your environmental counterparty risk. You want to flag that to people more than just your immediate supervisor. You want to share that with your treasurer, your controller, your CFO, because it's a concentration of risk which represents a different type of issue that your organization may want to disclose in a financial report, either publicly or just privately internally. Next, you want to share those insights with your corporate finance team because you'll want to be able to communicate on a consistent, clear, and straightforward manner what the value of other organizations' commitments to yours is. And if there are commitments and guarantees and environmental liabilities, if there's one, there's many. So counting those up and identifying those is incredibly practical and useful because they're, again, part of the reason that you may value a liability at zero is because you've got a commitment or guarantee from somebody else. If you don't document it that way, when a new liability shows its ugly head, it may be difficult to rewind the clock and explain it a different way of we thought one thing last year, now we think this thing this year. So in other words, to look competent, to appear to have hands-on all appropriate information, it's again useful to have an awareness of what commitments and guarantees are in place. Next, it probably would be important to know the other way of what promises we made to others, document those accordingly, and then sum up the counterparty risks that you have with any one individual party and see how that compares. And it's usually a simple email or a simple phone call, but see how that exposure or concentration of risk looks relative to the amount of business that your company is doing with that counterparty right now. In other words, if your company says, we have company XYZ as a customer, and you say we have company XYZ as an environmental counterparty, it's pretty ordinary in some industries where you have both. But if you step back for a second and say, well, the operating business says we will give this company XYZ $1 million worth of products, and the payment terms are 30 days. That's one thing. That's a credit decision. Now, if you get into the liability counterparty risk situation, you can be there saying, well, we have $10 million of counterparty risk over the next 30 years with this very same customer. You can see the asymmetry. Your core business is saying $1 million only going out the next 30 days. Your environmental liabilities, however, show an exposure of $10 million over the next 30 years. That's normal. However, that's something that a CFO, a controller, a finance team can act on and do something to mitigate. If you work with a due diligence team, this also puts you in a position of pricing in credit rating differentials because you want to be able to explain to a team that buying or selling those commitments, those guarantees, is worth a premium or discount the way I've got it expressed here. And if you're a healthier organization, it's because you're more likely to pay your liabilities in full, and a seller may not, or a successor buyer may not be as financially healthy as your organization. Therefore, you're going to value them differently because you're in different financial conditions. With that in mind, let's move forward to how to display this information. We think it's very useful to use something called a watch list, which we put into the new ASTM standards E2137 and E2173. This display isn't in there, but the idea of using recognition benchmarks and obligating events to identify when you're going to re-up your estimate for an environmental liability, we find those are very useful triggers to document and to score. So what I've done here is just show an example table of what a company's counterparty risk setup may look like. They're broken out into the different types of liabilities. We've got in the center column AROs for asset retirement obligations, ERLs, environmental remediation liabilities, then commitments, contingencies, and guarantees. That's actually the order that they're listed in general accepted accounting principles. They're not in that order for any other reason. But then you get into the math, which goes off left to right. Once you have a recognition benchmark laid out, you then have the current counterparty credit score, which in turn equates and highly correlates to a 10-year or 30-year probability of default. And then you express that out even further. What's the opening and closing dates of those risks? And I'm reading the center columns here in this table. What are the risks? When do the risks open and close? What is the loss given default? And those aspects transparently give you a calculation of what is the gross environmental counterparty risk, less your self-default probability and cost, and then what is your net environmental counterparty exposure. And that in turn will look something like this. You'll say that we have a gross counterparty risk of 130 million, less the probability of our own default around 25 million, so we have a net counterparty risk of around 104 million. And for a company that has $1 billion environmental liability portfolio, knowing that there's this other issue that's 10% of the total is, again, particularly material and relevant to that. So with that, when we wrap up on our takeaways, there's an opportunity cost to not looking into the counterparty risk. And it's really what I would characterize as a tax on inexperience. GAAP tells you to track it. It's a known issue. Solutions are less expensive than the costs, and the solutions are more valuable than the costs. And counterparty risk grows exponentially over time. These risks have been triggered. They've been in place for decades or years already. Catching them as they continue on is something you can do because environmental liabilities are the way they are. There are project delays that are pretty common. And for owned properties, there might be some operational issues of how you bought into or sold off an asset or a liability. Things like standstill agreements, no-look agreements can be in place. Keep in mind, again, having a standstill agreement or a no-look agreement about a particular environmental liability is not unusual. It's not unheard of. However, it gives time for counterparty risk to set in. So I don't care if you have a standstill agreement or a no-look agreement. I'm pointing out that that standstill or no-look agreement puts you in business with trusting the financial health of the counterparty that you're in business with because of that standstill or no-look agreement. If you need more details about standstill or no-look agreements, Greg Rogers, who is one of the lights in this field of looking at environmental liabilities, Greg Rogers has done some great articles about the impact of standstill and no-look agreements on obfuscating what environmental liabilities look like today. And I'm pointing out, yes, if you factor in more time and delays into environmental liabilities, you give a great environment for counterparty risk to fester and grow. The other topics I've covered here today were in a larger, more dynamic economy, and the value of regulatory risks keeps growing. So again, keep in mind where we are today and where we're headed. With that, I'll wrap up our webinar today with just some normal concluding points. Our website is ERCI.com. We have a LinkedIn group in place, and you're welcome to connect to me personally as well. We've also got a YouTube page where, if you're listening to the recording of this, you probably already know about our YouTube page where we store webinar recordings on this and other select topics. We tend to turn them over, so if you see a webinar that's only got 2 views or 5 views, that just means that we are trying every year to put in a more current, more updated version in place. If you need more information, feel free to drop me an email, give me a call, and if you'd like a PDF of this presentation for your own use, we're trying to raise awareness like anyone else about these fields, this field of endeavor, this aspect of managing environmental liabilities. Feel free to reach out. It's a topic that we know and love and we try to be very good at. If you're interested in other topics that we're issuing or we're giving in this cycle in December 2016, our current cycle is calculating environmental liabilities, then this topic of counterparty risk, presenting and disclosing environmental liabilities, and fair value measurement. With that, let me conclude the recording, and thank you for joining our webinar today. Appreciate your time.